Good morning to you all, and I welcome you to SHS2 online vacation class, accounting lesson 1. In today's class, we are going to continue with the adjustment to the final account of a sole trader. You remember back in school when you were here, we discussed the final account of a sole trader, and we indicated that there are 3 main final accounts of a sole trader. 2 of them are account, and the third one is a financial statement. And so you remember we mentioned them. The first one was the trading account. The second one was the profit and loss account. And the third one was the balance sheet. And I remember we discussed extensively what each of them is used for, or the purpose for preparing each of them. But just as a reminder, we indicated that the trading account is prepared to determine gross profit or gross loss, while the profit or loss account is prepared to determine net profit or net loss. And the balance sheet, which is also known as the statement of financial position, is prepared to show the assets, capital, and liabilities of the business. So these were a few things we discussed. We saw the format for preparing each of them, and we saw illustrations for which even a question was given during your mid-semester exams. So we are looking at adjustment to these final accounts. Now, what are adjustments? Adjustments are corrections or further workings that are made in the final account of the business. And so it so happens that at the end of the year, some of the account balances need to be adjusted or corrected simply because we are getting new information, or there are omissions or errors we made for which it has become necessary for us to make these adjustments. So note that they are corrections or further workings. In your manual, you will see adjustment as changes made in the final account of a business. Now, there are several of them, but in this lesson, we are going to pay attention to 4 of them. So the 4 are accrued expenses, prepaid expenses, accrued income or income accrued, and income prepaid. So the summary is that today we are looking at expenses and income. So expenses and income. The expenses could either be accrued or could be prepaid. And we can say same for the income, which can also be accrued or prepaid. Now, I want to believe we all appreciate what expenses are and what income are. And so let's pick the first one, which is accrued expenses. Accrued expenses refers to amount of expense that have been incurred but not yet paid for. And I'd want you to note the key term, that these are expenses that have been incurred but have not yet been paid for. So for example, if you go for the building of an individual, or let's say a landlord, and you use it for 1 year and you don't pay, or you haven't made any payment for that particular expense, rent, then we can say the rent has accrued. Now, the other terms for accrual could be outstanding, owings, unpaid, or due, which simply means that you haven't paid, so you are owing. So for businesses that have accrued expenses, these are the accounting treatment in the final account. You already know that expenses are shown in the profit and loss account. So if there is any outstanding expense or any expense that has not been paid, we have to include it. And so in the profit and loss account, it is added to the expenses paid, and the result is debited to the profit and loss account. So what it means is that when you are preparing your profit and loss account and there is any outstanding expense, you will add it under your operating expenses. Now, in the balance sheet, since you haven't made payment for this expense, it is shown as a current liability. Because it is an owing, you would have to show it as a liability. So note the treatment very well. In the profit and loss account, you add the expenses that has accrued or that is due or outstanding or that has not been paid. And in the balance sheet, you show it as a liability. And if you acknowledge the scenario I cited, then you would appreciate that if you are using or you have used somebody's building for 1 year and you haven't paid rent, that is technically a liability, a debt you have to pay or settle. Let's look at an example in your learner manual. So it says that if you used water worth 140 Ghana cedi but have not paid it yet, then it is called an outstanding expense. So for those of us in these kinds of settlement, we call them compound houses. At the end of the month, whoever is in charge, disburses the arrears or the outstandings on water bills for us to settle. So if you have used water and you have not paid for it, then that quantum can be termed as an expense outstanding or water bill outstanding or water bill accrued. So if you were to prepare your profit or loss account, you would have added this amount to your expenses. And of course, you also acknowledge that it is a liability, it's a debt, a current one for which you have to settle within the shortest possible time. The next we'll look at is the prepaid expense. So this is virtually the opposite of accrued expense. What is prepaid expense? This refers to an amount of expense paid in excess of what has been incurred. It is also called expenses paid in advance. So here, unlike the first case where we haven't paid, this time we have paid in excess. So if the water bill was 150 Ghana cedis, we have made payment for 200. So if you check the difference, which is 50, then that becomes the prepaid expense. I'm repeating the point that these prepaid expenses are expenses we have paid in excess of what we actually incurred. So you went for the building of a landlord for 1 year. You were supposed to pay 2,400, but you paid the landlord 3,000. So we can say or conclude that the difference of 600 is a prepayment, which will be set against the next period. That is, if you are going to continue to use the building. How do we treat prepaid expenses? Because technically, they are not expenses that relate to the particular year. We subtract them or we deduct. So in the profit and loss account, any expense prepaid, any excess is deducted from the expenses and the result is debited to profit and loss. Now, in the balance sheet, it is shown as a current asset, simply because if you have paid the landlord in excess, that excess amount is your asset, your current asset. So we can take an example in the manual as follows. So in the example, it reads, or this is the example. Assume you pay 3,000 as rent within an accounting period, but the total that you are supposed to pay is 1,800. So follow it closely. You paid 3,000 as rent, but the total you are supposed to pay is 1,800. So this means that the difference, which is 1,200, is the excess, and this excess is the prepaid expense, meaning you have paid in advance. You have paid in excess of actually how much you are supposed to pay. So if we were showing this in our profit and loss account, then under the operating expenses, you would indicate rent of 3,000, and then you subtract or you less the prepayment of 1,200. Now, when you do that, then it means that you would arrive at the exact or the true rent that should be paid for the particular year of 1,800. So this is how it will show in your profit and loss account. You put the rent paid and then you less the prepaid. And then in the balance sheet, you would show this prepayment of 1,200 as your current asset. Let's move to the third one. The third one is prepaid income. So we have finished with the expense part. We are looking at the income. Prepaid income, what does it mean? You know, income refers to the inflow to the business or what the business has earned from either rendering services or providing goods. So for example, if we are a soap manufacturing company, then anytime we sell soaps, the amount we receive can be referred to as income. So we are saying this income could be prepaid. What does it mean? It refers to an amount of income received in excess of what has been earned. It is called income received in advance. So here, the business is supposed to receive some inflows, but those inflows were in excess of actually how much the business was supposed to receive. So let me give you an example that we rendered some services and we're supposed to receive some commission. Now, this commission that we were supposed to receive was 1,000 Ghana cedis. But it turns out that we were paid or we received 1,200. So what this means is that we have received 200 in excess of actually how much is due us. So we have received the income in excess or in advance, and that's prepaid income. You would agree with me that technically the excess 200 is not for us as a business because we haven't earned that amount of money. So it only makes sense to say that in the balance sheet, it is a current liability to the business on the basis that this excess has not been earned. So it is not a resource to the company. So if you set up your business and somebody pays you in advance before you render a service or provide a product, then that is a current liability because you have received the income in excess of what you are actually supposed to receive. So if I want to give another example, if your father is supposed to give you chop money for a month, 200 cedis, and then it happens that he sends you 250 Ghana cedis. If you are looking at your account for that month, you cannot see the 50 cedis is your bona fide pocket money because your actual pocket money should have been 200, but daddy has sent 250. So the 50 there becomes pocket money received in advance or prepaid pocket money. And for that matter, you would hold the 50 cedis as not yours because daddy can say, hey, give me back the excess. Or he can hold it against the next month chop money. So in the balance sheet, it is shown as a current liability. And again, since it is not our income, in the profit and loss account, we subtract or we deduct it from our income. Finally, let's look at the last one, which will be the accrued income. Accrued income. So let's look at that finally, and then we can wrap up for today's class. So accrued income. We have seen the accrued expense, prepaid expense, prepaid income, and we are left with the accrued income. So let me edit this slide so we can have the accrued income. So since you are now familiar with the word accrued, I'm sure you can suggest what it means. So accrued income here means or refers to income earned by a business but not yet received. So the business has earned the income, but they have not received that income. So the income is in arrears, or is due, or is outstanding, or is in arrears. So you can appreciate that this is monies we are supposed to receive, or this is money we are supposed to receive, but we haven't received. So in our profit and loss account, in terms of accounting treatment, so in the profit or loss account, what we are going to do is we will add to the income. And in the balance sheet, I'm sure you would be able to guess right that it will be shown as a current asset because these are monies that the business can lay claims over because we have earned that income, just that our customers have not paid. So my dear students, we have been able to exhaust these 4 adjustments. And the first one we saw was the accrued expense, the second accrued income, the third prepaid expense, the fourth prepaid income. And what I want you to grasp is for you to be able to tell how to deal with them in the profit or loss account and the balance sheet. We'll end today's session here and continue another time. Make sure to check the link to go and do the exercise on this particular topic. Till I see you next time, stay safe. Bye-bye.